This video will teach you how to prepare journal entries and statements. In our first example, you have a tutoring business and you receive $50 for tutoring a student. Your journal entry will be to debit cash because you received the cash, and you would credit income for $50. In our next example, you pay $25 for supplies. You would debit supplies expense and you would credit cash for $25 because cash is going out. This slide shows the cash T account. A T account helps you determine what your balance is in a particular account. This shows the debit of $50 for the first transaction and a credit of $25 for the supplies expense. Thus, your balance for your cash is $25. This should tie to the balance sheet for your cash and also to your bank statement. A debit is always an asset. Thus, if you had more in the credit balance on your cash T account, like if you had $75 that you paid out for the supplies expense, then you would have overdrawn your cash. Thus, this would become a liability. This next slide shows what your income statement would look like if you only had these two transactions. Your gross income would be $50 from the amount that you received from tutoring. You have $25 in supplies expense, thus your net income will be $25. The balance sheet for your company would look like this if there was only those two entries. You would have cash of $25, which ties to our T account and also would tie to your bank statement. You have retained earnings in the company of $25, which is what your income statement showed, the $25. Thus, your balance statement is in balance. Your assets equal your liabilities and equity, as it will always equal.